Welcome back. All right, let's just dive right in. Today, we're popping the hood on Vince Holding Corp's first quarter earnings for fiscal 2026. Now, if you follow the retail and luxury apparel space, you know perfectly well that the last few years have been, well, a really complex macro environment for brands to navigate, to put it mildly. But in today's explainer, we're going to unpack the overarching narrative of Vince's strategic turnaround. As you'll see, the data is pointing towards some seriously accelerating business momentum.
Here is our roadmap for today. We are going to kick things off with the first quarter highlights, break down that segment performance, and then dive right into the profitability picture. After that, we'll cover the balance sheet and tariffs, and finally wrap the whole thing up with their future outlook and guidance. Let's go! Starting with Section 1, First Quarter Highlights. Let's look at exactly what happened in Q1 2026.
Boom! Right out of the gate, just look at this number. Total net sales for Vince increased by 10.5% year over year. That brings their total Q1 revenue to a very healthy $64 million. You know, in today's highly competitive market where consumers are spending super carefully, seeing an established apparel brand pull off double-digit top-line growth, that is a massive signal. It tells us right away that whatever strategic changes management has been making behind the scenes, the consumer is definitely responding to them.
And that points to a really clear thesis for us, which CEO Brendan Hoffman basically hit the nail on the head with. He said, "We delivered strong first quarter results that demonstrate the powerful momentum we've built is not only sustained, but accelerating." The absolute key word there is accelerating. This is not just some momentary flash in the pan. It's a snowball effect. The investments they're making in their foundation are clearly compounding.
Moving right along to Section 2, Segment Performance Breakdown. Let's see exactly where that growth is coming from.
What's really fascinating here is the contrast. We're looking at a multi-channel strategy that is absolutely firing on all cylinders, but in very different ways. The wholesale segment, think department stores and those premium retail partners, grew by a highly respectable 5.9%. But look at the direct-to-consumer, or DTC segment. That shot up by a massive 15.6%. Management credits this to some really strategic investments in the overall customer experience, which successfully brought in totally new shoppers while also reactivating dormant ones.
And when you look directly at the breakdown here, you can see how this growth is actually impacting their revenue balance. Check out the top section under net sales. Vince Wholesale brought in just over $32 million, and Vince Direct-to-Consumer brought in $31.9 million. They are practically tied. Honestly, this is exactly what you want to see in a modern retail brand. It's a perfectly balanced omnichannel presence where you aren't overly reliant on those third-party wholesale partners to drive your revenue.
All right, Section 3, the profitability picture. Time to talk about margins.
So the crucial point here is understanding the push and pull factors that are messing with their margins. Gross profit for the quarter landed at 50.6% of net sales. Now, on the favorable side of things, they saw a nice expansion of 130 basis points from higher pricing, and another 100 basis points simply because they didn't have to discount their clothes as much. Basically, people were happily buying at full price. But pulling against all that success was the incredibly unfavorable drag of higher global tariffs. Let's ground ourselves in the actual consolidated statements for a second to look at their operating costs. I want to draw your attention down to the selling, general, and administrative expenses line. In pure dollars, their SG&A costs went up to $35 million, which totally makes sense, because they're actively investing in things like marketing, advertising, and employee benefits. But, and this is the absolute core benefit of revenue growth, as a percentage of total sales, those expenses actually dropped from 58% last year to 54.7% this year. That right there is textbook operating leverage. Now, we do need to be totally transparent here. The company still posted a $2.6 million operating loss for the quarter. But remember, context is literally everything. Last year, in the exact same quarter, that operating loss was $4.4 million. So, okay, while they aren't fully in the black just yet on an operating basis, they have nearly chopped those losses in half. This rapidly narrowing loss is exactly why the CEO is using the word accelerating to describe their overall momentum.
Section 4, Balance Sheet and Tariffs. Let's evaluate that financial runway.
Net inventory ended the first quarter at $70.8 million, which is up from $62.3 million at this exact same time last year. Now, on the surface, a rising inventory balance like that can sometimes be a bit of a red flag for a retailer. However,
This is exactly why reading the context in the footnotes matters so much. The company clarified that $4.5 million of this year-over-year inventory increase isn't actually just piles of extra clothes sitting around in a warehouse. It's simply a higher carrying value caused directly by tariffs. So the actual physical volume of their inventory isn't wildly inflating. It's the geopolitical cost of holding it that's going up. And when we look at their liquidity, they're really in a pretty solid position. They have total borrowings of $29.1 million, but importantly, they've got $31.2 million of excess availability under their revolving credit facility, meaning they absolutely have the financial runway they need to just keep executing on this turnaround strategy.
And finally, Section 5, Future Outlook and Guidance. Let's look ahead to the rest of the year.
Management is absolutely not resting on their laurels after a good first quarter. For Q2, they expect this momentum to hold totally steady, forecasting a net sales increase of 10 to 12%. What's even better, they expect to be solidly profitable on an adjusted basis, targeting adjusted operating income margins between 6.5 and 7% and adjusted EBITDA margins between 8 and 8.5%. They're basically expecting this growth to keep rolling straight through the summer.
And here is the real kicker. Because of the strong execution we've just tracked, management has officially raised their full-year guidance. They now expect fiscal 2026 net sales to increase by 7 to 8%, with adjusted operating income up to 4.5% and adjusted EBITDA up to 6%. Listen, when a leadership team publicly raises their guidance across the board like this, it's the ultimate signal of internal confidence.
But there is a very important and honestly very smart caveat to all this. This raised outlook conservatively bakes in an assumption of a 10% tariff rate on inventory receipts. The Supreme Court recently struck down certain tariffs, right? But Vince's management is intentionally not factoring any potential tariff refunds into this guidance. They're basically planning for the absolute worst-case tariff scenario, meaning if they do end up getting a refund down the line, it will be pure upside to these numbers.
So, to wrap this all up, they've proven their direct-to-consumer investments are massively paying off, and they've narrowed their operating losses significantly. But the retail landscape is literally never without its challenges. It's going to be absolutely fascinating to watch their Q2 numbers roll in to see if they can actually beat their own raised expectations. The big question we're left with is, can VNCE maintain this impressive double-digit momentum as global tariff pressures and macroeconomic uncertainties continue to loom over the industry? We'll have to wait and see.